10 Timeless Investing Principles That Can Make You Rich. Warren Buffett. Warren Buffett distills investment success into 3 words, margin of safety, and tells investors to take one of 2 approaches, either focus on value or buy an index fund. Buffett, the Oracle of Omaha, has been steadfastly giving such advice for decades, through calm and choppy markets alike. Today we're going to talk all about the 10 timeless investing principles that can make you rich. So watch the video till the end, because today's video is going to be the bomb. Welcome to Investor Secret, your daily dose of wealth secrets. If you're interested in everything around big investors and their investment techniques, this is the place for you. Subscribe if you want to stay updated with all the investor secrets, predictions, and stay one step ahead in the financial world. Watch the video till the end, and make sure to hit the like button if you want to be a millionaire within the next 3 years. Don't forget to enable all notifications to join our weekly cash giveaway pinned in the comments. Now let's get to our topic. At the time, Buffett's investing style was out of fashion. Critics said the Oracle had lost its touch, misunderstanding the go-go new economy and its game-changing technology. But Buffett foresaw exceedingly high stock prices, which soon proved correct. Moreover, 2 decades later, his value-based investing style has not only survived, but thrived, due in large part to 3 pivotal components. First, margin of safety refers to paying a low price compared to value obtained. In theory, there is no difference between stock price and business value. If markets are efficient, then prices are good estimates of value. But investors like Buffett laugh at this efficient markets theory. At the symposium, Munger labeled it twaddle and gibberish. Buffett and Munger say that market prices gyrate above and below business value. In the 1950s, Buffett's Columbia University professor, Benjamin Graham, offered the image of the market as a manic depressive, veering from euphoria to gloom, though the reality is neither wonderful nor awful. So avoid overpaying and buy low, Buffett and Munger say, but don't go to extremes. It's better to buy a great business at a fair price than a fair business at a great price, Munger has famously quipped. At the 1996 symposium held in New York at Cardozo Law School, the Berkshire executives referenced some of their earliest and savviest purchases, such as shares of the Washington Post Company in 1973-74, at a price about 1/5 of its value. Today, look to Berkshire during the financial crisis of 2008, as it invested throughout corporate America, from Goldman Sachs Group GS to USG Corp at prices yielding enviable margins of safety. Second, focus on exceptionally valuable companies, those already run successfully, rather than turnaround prospects. After all, change is both difficult and uncertain. Buffett explained at the symposium, "We try to buy into businesses with excellent economics, run by honest and able people at a decent price. We buy very few securities, so we look at it as focused investing." In annotations I solicited for the Buffett Essay Symposium, the author Robert Hagstrom writes, "Warren popularized the concept of focused investing, a portfolio management approach that concentrates one's bets on those stocks that have the highest probability of beating the market over the long term. Shareholder activists and venture capitalists manage for change, but as Munger warned at the symposium, doing so creates complicated legal problems he'd rather avoid." Buffett meanwhile stressed that those decisions arise from needing an exit strategy. In contrast, he said, Berkshire looks for a non-exit strategy, things we'll never want to exit. Non-exit businesses are those commanding competitive advantages that deter rivals and withstand technological onslaughts for years, such as barriers to entry or brand strength. Buffett calls these features moats, like medieval defenses fortifying castles. Such quality businesses are desirable when run by people you like, trust, and admire, individuals you'd be happy to have your child marry, Buffett advises. Finally, know your limits and avoid investment targets outside what Buffett dubs your circle of competence. So, if you cannot make required judgments about value, moats, and managers, then invest through low-fee index funds. Doing so beats the after-cost results most professionals deliver. As they say in poker, if you've been in the game 30 minutes and don't know who the patsy is, you're the patsy. Buffett implores you, don't be the patsy. At the 1996 symposium, Bill Ackman, then a little-known investment novice in our audience, challenged index investing as a social practice and defended what would become his brand of shareholder activism. Ackman contended that as more capital is indexed and voted algorithmically for average returns, too much is staked in larger companies just because they're in the index. Munger, moderating the symposium's investing panel, concurred. "You are plainly right. If you pushed indexation to the very logical extreme, you would get preposterous results." On the other hand, countered Jeff Gordon of Columbia University, index fund operators actually have incentives to promote superior governance and performance across the board. As long-term owners with large stakes, he reasoned, they are a bit like Charlie and Warren, whose focused investing influences manager behavior. So more indexing through big players may be better for all of us, except perhaps the most sophisticated. Concluded moderator Munger, well, ladies and gentlemen, you have just heard a very subtle and profoundly correct point. Following up on the symposium, in an interview with Forbes magazine, I credited Graham with designating margin of safety decades earlier as the key to investment success. I said Buffett still agreed. That remains true now, 20 years later, and that simple pearl of wisdom will likely remain the key for decades to come. All investors, focused, activist, or indexed, can thank Ben, Warren, and Charlie for this perpetual payoff. Be mindful of experts and forecasts. This is not magic. When everyone who wants to buy has bought, there are no more buyers. At this point, the market must turn lower. Similarly, when everyone who wants to sell has sold, no more sellers remain. So when market experts and the forecasts are telling you to sell, or buy, be sure to know that everyone is jumping on that bandwagon, so much so that there's nothing left to sell or buy. By the point you jump in, something else is likely to happen. Bull markets are more fun than bear markets. This is true for most investors since prices continue to rise during these periods. Who doesn't love seeing their profits rise? Well, unless you're a short seller. A short sale is when you sell an asset that you don't own yourself. Traders who use this strategy sell borrowed securities, hoping the price will drop. The seller must then return an equal amount of shares in the future. A clear understanding of your time horizon is key. One's time horizon dictates how much risk can prudently be taken within their portfolio. It also keeps rough market conditions in perspective. If you're a long-term investor, then the current bear market should not scare you. In fact, it should excite you. It offers you the wonderful opportunity to buy equities at a meaningful discount compared to what they were trading at just a few months ago. If you are a short-term investor who planned properly, you also should not be scared by the current bear market. Your portfolio should have been sitting in cash or allocated to high-quality bonds. In such a situation, the current environment should not impact you at all because your investments are not plummeting in value. It's irresponsible to invest without having a clear understanding of when you need to use the money. Well, that's it for today's video, guys. Also, we would like to mention that this is not a channel intended specifically to provide financial advice, and we do not ask you to invest in any company. This is merely a channel directed towards bringing educational content to your doorsteps. With that in mind, before you invest in anything, we recommend you do thorough, wide-spectrum research on the topic. And make sure to subscribe and give us a thumbs up. See you next time on Investor Secret. Bye!